This story just breaking from the team over at Bloomberg that the EU is said to be planning to propose removing some U.S. industrial tariffs this week. Why would that move be taking place? What would the EU be hoping to accomplish?
Germany, Europe's economic engine, just slammed the brakes on Washington's plans. According to sources in the Chancellor's office, a high-level meeting ended with what one insider called a polite but absolute refusal. Tension rose as German officials challenged the very premises behind U.S. trade demands. Here's why that no matters. Germany generates over $4 trillion in annual GDP, more than any other European nation. Its industrial base, from world-class automotive tech to precision manufacturing, keeps global supply chains running. So when Berlin rejects a deal, boardrooms from Frankfurt to Munich take note. At issue trade frameworks that would have granted American firms unprecedented access to German markets with too little in return. Negotiators walked when terms looked fundamentally unbalanced, threatening Germany's ability to protect domestic industries and workers. The shockwaves extend far beyond trade. NATO spending plans, joint defense projects, and critical tech partnerships are suddenly uncertain. Billion-dollar German defense contracts wobble. Advanced manufacturing agreements, years in the making, face cancellation, forcing U.S. companies to scramble for new suppliers. There's a human cost, too. American workers in states tied to German auto investment, Michigan, Alabama, South Carolina, now see job security linked to a chill in diplomacy. German companies directly employ over 800,000 Americans, 800,000 families, whose futures just got murkier. And the timing stings. Germany acted while hosting U.S. bases, buying U.S. defense systems, and maintaining the appearance of Allied unity. The message's blunt partnership isn't subordination. Economic sovereignty outranks diplomatic pressure. Next, France answers Berlin's no with something even more devastating. France, the nation that once gifted America the Statue of Liberty, just returned a far less generous token, a diplomatic slap heard across centuries of shared history. This rejection didn't even come through traditional diplomacy. French leaders bypassed the usual channels entirely, signaling that this was not about negotiation, but principle. French officials branded the American proposals incompatible with European values and sovereignty. The president's office went further, openly questioning the assumptions behind U.S. demands. By speaking of European sovereignty and strategic autonomy, France drew new lines that didn't exist 6 months ago. These are not temporary stances. They mark generational shifts in policy, reflecting Europe's growing confidence in challenging U.S. dominance. The economic fallout is severe. France controls access to African markets worth hundreds of billions, dominates global luxury goods. American consumers crave and runs nuclear technology critical to Europe's power grid. French firms hold major stakes in U.S. infrastructure, from water systems to transport networks, exposing vulnerabilities Washington never anticipated. Agriculture sharpens the blow. U.S. negotiators hoped to crack open Europe's heavily protected farm sector, but French agriculture remains sealed tight. That means French wine, cheese, and specialty foods, staples in American supermarkets and restaurants, now face disruption. Partnerships from California vineyards to Texas cattle ranches suddenly hang by a thread. The aerospace sector is also rattled. Joint ventures worth tens of billions must now be renegotiated or scrapped. And beyond economics, France's soft power, its global cultural influence, gives legitimacy to others resisting U.S. pressure. When Paris rejects, the world listens. And just as France draws its line, Italy, historically more accommodating to Washington, prepares to deliver a crushing blow of its own. Italy, the Mediterranean crossroads, has long been a willing partner, even when other European capitals resisted Washington. That history makes its rejection all the more dramatic. Italian officials describe the U.S. proposals as demanding unacceptable compromises to national dignity and economic independence. The implications run deep. Italy controls vital maritime access ports that have for decades handled American goods bound for Europe and Africa. When Rome says no, it doesn't just sour relations. It risks disrupting billions in annual trade flows. At the center of the clash were economic frameworks designed to restructure Italy's role in European trade while handing American firms preferential access to Italian markets. Negotiators walked away calling the terms a direct assault on sovereignty. For a nation that has often balanced U.S. and European interests, this language signals a profound shift in strategic thinking. The financial world feels the tremors too. Italian banking systems are deeply entwined with American institutions. Political strain threatens billions in cross-border transactions, shaking long-term partnerships both nations rely on. Meanwhile, Italian manufacturing luxury goods, machinery, fashion supplies, components across U.S. industries. A rupture here would force expensive supply chain overhauls and cut Italian firms off from a crucial export market. Italy's rejection doesn't just sting, it destabilizes Mediterranean trade itself. And as Rome closes its ports, America's most trusted trading partner, the Netherlands, prepares to pull the rug out from under U.S. access to Europe. The Dutch rejection cuts especially deep because it comes from America's most dependable European trading partner. The Netherlands is the gateway to Europe for U.S. goods. When they say no American companies feel it instantly through canceled contracts and disrupted logistics. Rotterdam, Europe's largest port alone, handles more than 60% of American exports entering the continent. While operations aren't shutting down overnight, the political uncertainty makes long-term planning nearly impossible. Firms are now weighing costly alternatives that could upend supply chains built over decades. The Netherlands also hosts more American multinational headquarters per capita than any other European nation. Those companies came for tax frameworks, regulatory protections, and business-friendly policies. But with Dutch politics shifting and EU regulators circling those advantages are suddenly under threat. Agriculture and innovation are no safe havens either. Dutch agribusiness among the world's most advanced partners with U.S. companies in seed tech machinery and food security projects worth hundreds of millions. Political strain jeopardizes this cooperation, while research ventures in sustainability, climate adaptation, and urban design now face delays or cancellation. The financial sector feels it too. Amsterdam, a rising rival to London, positioned itself as a hub for U.S. firms after Brexit. Now, uncertainty over regulatory cooperation may force relocations and restructuring at staggering cost. For decades, the Netherlands has been America's reliable anchor in Europe, but with that anchor lifting, Sweden delivers a rejection even more dangerous, targeting the defense technologies the U.S. military depends on. Sweden's rejection doesn't just sting, it shakes the foundation of American defense and technology cooperation. This isn't a minor trading partner stepping away. It's a nation whose innovations are embedded in U.S. military systems, from advanced radar to specialized communications equipment. Swedish officials dismissed the proposals as incompatible with Nordic values of independence and collaborative innovation. That refusal comes at a sensitive moment while Sweden is negotiating NATO membership that should, in theory, draw it closer to Washington. Instead, it reveals a deeper disagreement alliance. Yes, subordination. No. The consequences are immediate. U.S. defense industries depend on Swedish components to maintain technological superiority against global rivals. Losing access to those systems could set development back years. Civilian industries are equally exposed. American firms rely on Swedish telecom equipment software and specialized parts. A breakdown here means expensive supply chain overhauls. The ripple extends into research. Swedish universities and labs are tightly linked with U.S. counterparts in climate science medicine and advanced manufacturing. Political interference now threatens to slow projects critical not just for business, but for global progress. Energy cooperation also stands on shaky ground. Sweden's nuclear technology and renewable innovations feed directly into American infrastructure plans. Sweden's defiance hits hard. But what Austria does next, cutting America off from its bridge to Central Europe, raises the stakes even higher. Austria's stance delivers a shock that goes far beyond its size. For decades, Vienna's neutrality made it an ideal bridge for U.S. interests in Central Europe. When Austria says no, it signals a deeper shift. Europe no longer sees Washington as the indispensable partner. Austrian officials rejected the proposals outright, calling them inconsistent with the nation's constitutional neutrality and its tradition of multilateral cooperation. This cuts directly into finance. Austrian banks have long connected American capital with Central and Eastern European markets. Their networks built on trust and regulatory expertise now face political strain just as those emerging economies begin to surge. Billions in U.S. investment opportunities could vanish overnight. American companies that chose Austria as their regional headquarters now find themselves exposed. Tax treaties, legal frameworks, and business-friendly policies that once made Vienna attractive are suddenly under fire. Whole divisions may need costly relocation. Tourism adds another layer. Austria thrives on U.S. visitors with American hotel chains and franchises woven into its economy. But political chill could dampen flows worth billions in annual revenue. Worse, Austria's role as a neutral mediator in global diplomacy becomes compromised. If Vienna can't credibly host talks, the U.S. loses a vital platform for conflict resolution. Austria's neutrality was once America's asset. Now it's America's obstacle. And just as this bridge collapses, Denmark, a nation that has fought alongside the U.S., delivers a betrayal Washington never expected. Denmark's rejection cuts deeper than most because it comes from a steadfast ally. For decades, Copenhagen stood shoulder to shoulder with Washington, committing troops to American-led operations far beyond its size. That loyalty makes today's break a stunning reversal. Danish officials declared the U.S. proposals fundamentally opposed to principles of multilateralism and sovereign equality. The impact strikes at the heart of maritime cooperation. Danish shipping companies and ports are critical for U.S. access to Arctic resources and Northern European markets. Political uncertainty now clouds decades of smooth operations, threatening trade worth billions. Agriculture feels the shock next. Denmark has long served as a gateway for U.S. grain beef and processed foods into Scandinavia. Political disputes could unravel those supply chains, leaving American farmers and processors scrambling to find costly alternatives. Then comes biotech. Danish pharmaceutical and research firms are deeply tied to American counterparts through shared labs and joint projects. Political interference risks slowing drug development and even endangering public health cooperation. Even design and lifestyle industries are caught in the storm. Danish furniture and design, beloved in American homes, now faces an uncertain future in U.S. markets. Denmark's betrayal hurts, but what Poland does next threatens to collapse Washington's entire Eastern European strategy. Poland's rejection is nothing short of seismic. For years, Warsaw has been one of Washington's most loyal allies in Europe, aligning with U.S. policies, investing heavily in American defense systems, and hosting joint military initiatives. So when Poland says no, it signals a tectonic shift in transatlantic relations. Polish officials framed the U.S. proposals as inconsistent with sovereignty and with their commitment to European integration. That language cuts deep. Poland spends one of the highest percentages of GDP in NATO on defense, much of it directed toward U.S. equipment. Billions in contracts now hang in the balance, with the very real possibility that Poland will pivot toward European suppliers. The economic damage is just as stark. American companies have poured investment into Polish factories, attracted by low costs, skilled labor, and central location. Now, political uncertainty clouds these projects, threatening thousands of U.S. jobs tied to Polish operations. Agriculture, too, is vulnerable. Poland's modernizing farm sector relies on American technology equipment and expertise. A political freeze risks unraveling years of cooperation, raising food security concerns across the region. Energy adds another layer of complexity. Poland's position as a transit hub for resources between Russia and Western Europe makes it strategic. U.S. firms invested in infrastructure to provide alternatives to Russian supply, but political rifts now threaten those investments, potentially undermining American energy security goals. Infrastructure is also at stake. Roads, railways, and construction projects funded by EU money and supported by US firms could face delays or cancellation, with both profitability and strategic access jeopardized. Poland's defection rocks the eastern flank of Europe, but Belgium's looming rejection threatens to topple the very institutions America relies upon to project influence across the continent. Belgium's rejection strikes at the heart of American power in Europe. This is not just another ally saying no, it is the host of the European Union's headquarters and NATO's command structures. For decades, Washington relied on Brussels as the staging ground for policy diplomacy and influence. That foundation now trembles. Belgian officials dismissed the U.S. proposals as fundamentally incompatible with their neutral role as hosts of international institutions. The consequences are vast. American companies using Brussels as a hub for lobbying and market access now face sudden uncertainty. Billions invested in influence networks and regulatory positioning risk collapse. Finance feels the blow immediately. Belgium processes immense volumes of international transactions and provides compliance expertise essential to American firms. Political strain could sever these arteries, threatening hundreds of billions in financial flows. Logistics and transport add to the pressure. Belgium's central location makes it a linchpin for moving American goods across Europe. Warehousing, distribution, and supply chains built around Belgian hubs now face expensive restructuring. Even defense cooperation is shaken. Hosting NATO facilities while rejecting U.S. diplomatic proposals creates contradictions that complicate daily operations of allied forces. At the same time, Belgium's biotech and advanced materials research, heavily tied to American partnerships, faces political uncertainty, threatening projects critical to both economies. With NATO headquarters itself under strain, the stage is set for Finland, a new member on Europe's northern edge, to deliver a strike aimed at America's Arctic ambitions. Finland's rejection carries unique weight. As a nation straddling east and west, its decisions have always been carefully balanced. With NATO membership fresh and its Arctic position vital, Washington expected alignment. Instead, Helsinki delivered a clear no. Finnish officials argued the proposals clashed with traditions of balanced diplomacy and technological sovereignty. That refusal lands hardest in technology. Finland's telecom giants and thriving gaming industry have deep U.S. ties. American companies rely on Finnish innovations in communications infrastructure while investing heavily in Finland's research ecosystem. Now political friction threatens to slow cooperation in sectors where speed defines global advantage. American firms with operations in Finland aimed not just at European access, but also at Arctic expertise, cold weather engineering, energy resilience, and navigation in extreme conditions. These specialized services are now clouded by uncertainty, just as climate change makes the Arctic more strategic than ever. Forestry and paper industries where Finland leads globally also face disruption. U.S. companies depend on Finnish sustainable practices and advanced materials. Political rifts could fracture supply chains spanning from publishing to packaging. Energy compounds the stakes. Finland's advanced nuclear programs and pioneering energy storage technologies form part of U.S. infrastructure planning. Political disputes risk derailing projects at a moment when energy security is already fragile. And above it all looms the Arctic. Finland's knowledge and geography make it indispensable for Northern strategy. By shutting America out, Helsinki forces Washington to reconsider its entire approach to the region. Finland's cold refusal sets the stage for Spain, whose rejection severs Washington's critical bridge to Latin America. Spain's rejection reverberates far beyond Europe. For decades, Madrid has served as America's bridge into Latin America, linking Washington's influence with markets, culture, and strategy across the Atlantic. That bridge just collapsed. Spanish officials declared the proposals incompatible with their commitment to multilateral engagement and strong ties to Latin America. The financial consequences are immediate. Spanish banks dominate Latin American markets, acting as guides for U.S. companies navigating complex regulations and cultures. Now those channels are threatened, risking billions in lost opportunities. For American firms, Spain has also been a vital operational hub. Cultural connections, language advantages, and established networks made Madrid an obvious choice for managing both European and Latin American strategies. Political strain now forces costly relocations and restructuring. Tourism and hospitality take a hit as well. American hotel chains and entertainment companies are woven into Spain's tourism economy, while millions of U.S. travelers fuel Spanish revenues. Rising political tension creates uncertainty in a sector worth billions on both sides. Defense cooperation feels the chill too. Spain hosts U.S. bases and joins joint military operations worldwide. If politics weaken that bond, American operational capacity in multiple regions could falter. Agriculture, olive oil, wine, and specialty foods adds yet another point of vulnerability, with established U.S.-Spanish trade ties suddenly at risk. By cutting this bridge to Latin America, Spain delivers a severe blow. But what comes next from Norway, master of Europe's energy lifelines, is even more devastating. Norway's rejection delivers one of the harshest blows, because it strikes directly at America's energy lifeline. As one of the world's largest energy exporters and a guardian of vast Arctic territories, Oslo's cooperation has long been central to U.S. energy security. Now that cooperation is unraveling. Norwegian officials branded the U.S. proposals as fundamentally opposed to principles of resource sovereignty and environmental stewardship. That language cuts to the core of Norway's identity as both an energy superpower and a global leader in sustainable policy. The fallout is enormous. American oil and gas firms rely on Norwegian offshore drilling expertise and LNG processing partnerships built over decades. Without them, U.S. companies face soaring costs for alternative supplies. Shipping adds more pain. Norway's advanced fleets and maritime services are vital for U.S. global logistics. Political strain threatens these arteries of world trade. Finance is also entangled. Norway's sovereign wealth fund holds hundreds of billions in U.S. assets. While managed with strict rules, political tensions create uncertainty that could ripple through American capital markets, affecting everything from stock prices to bond yields. On defense, the stakes are higher still. U.S. Arctic operations depend heavily on Norway's geography, ports, and expertise. With climate change opening new sea routes and resource frontiers losing, Norway's cooperation could cripple Washington's northern strategy at the very moment it matters most. And just as Norway tightens the noose, Luxembourg delivers the final strike, dismantling the financial architecture U.S. power depends upon. Luxembourg may be small, but its rejection is colossal. This nation is the hidden cornerstone of America's corporate empire in Europe. More U.S. multinationals are headquartered here relative to size than anywhere else on the continent. When Luxembourg says no, the financial architecture itself begins to crack. Officials dismiss the U.S. proposals as incompatible with their role as a neutral financial center and their commitment to European integration. The implications are staggering. Luxembourg's banking system processes vast volumes of American corporate transactions. Its tax frameworks and legal protections have been essential for U.S. companies to operate across Europe. Without them, firms face restructuring costs that could reach into the hundreds of billions. American investment funds and financial institutions have long relied on Luxembourg vehicles to access European markets. Now those structures sit on unstable ground. Hundreds of billions in assets could be forced into relocation, triggering chaos in capital flows. The impact spreads further. EU institutions based in Luxembourg, crucial for American companies navigating Europe's regulatory maze, may no longer offer the access Washington counted on. Losing that influence will cost billions in compliance and lost opportunities. Even tech giants are caught in the crossfire. Luxembourg's data centers and telecom hubs support U.S. digital infrastructure across Europe. If political tensions sever these ties, America's tech backbone in Europe could be dismantled at enormous expense, while security and efficiency hang in the balance. With Luxembourg's refusal, the circle is complete. From Berlin to Brussels, Paris to Oslo, America's European alliances have unraveled. What began as trade talks has snowballed into a continental rejection, a threat not just to deals, but to the very architecture of U.S. global influence. The question now is simple. Are we witnessing temporary turbulence or the beginning of an empire's decline? Flags still wave over NATO bases. American corporations still operate across European capitals, but the ground has shifted beneath them. Germany's industrial might, France's cultural power, Italy's ports, the Netherlands' logistics, Sweden's technology, Austria's neutrality, Denmark's loyalty, Poland's eastern bulwark, Belgium's institutions, Finland's Arctic expertise, Spain's Latin American bridge, Norway's energy, and Luxembourg's financial core all turned away, one after another. This isn't just a string of failed deals. It's a continental chorus declaring that partnership no longer means submission. Each rejection chips away at Washington's economic dominance, undermines defense cooperation, and fractures alliances that took generations to build. For the U.S., the consequences are measured not only in billions lost or contracts canceled, but in something far greater credibility. If even the closest allies reject American terms, what message does that send to the rest of the world? The question lingers, is this temporary turbulence or the unraveling of an empire? If this breakdown gave you a new perspective, don't just watch, be part of the conversation. Subscribe for more deep dives into the shifting global balance, and stay with us as we track the turning points that will define a generation.